Hey everybody, we're going to talk about a company called Markel today. They are one of my favorite stocks to own, to write about, to talk about, but I haven't covered them that much lately. But they are considered kind of the closest thing to an early stage Berkshire Hathaway in the market, just because they have a very similar business model to Berkshire Hathaway with a insurance business, a stock portfolio, and some owned companies. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now for free from the Motley Fool. It is the best way to support this work I'm doing, so please check out fool.com/Frankel. So I'm going to go ahead and share my screen before we go any further. And so Markel, they just reached an all-time high after they released their latest earnings. About $2,000 a share. It's pulled back a little bit since, but still doing very, very well this year. If management can execute on its strategy and the insurance market conditions can normalize, which I'll talk about a little bit more in a second, I think this will be a $5,000 stock by 2030. It's kind of underperformed the market. I've been a shareholder for about 10 years, and it's underperformed the market for a while, but I think that could be about to change. So first, the earnings were fine. There's nothing wrong with them. They had a great fourth quarter, great 2024. They beat expectations on both the top and the bottom line in the fourth quarter. Net investment income increased by 25% year over year. Operating income, the whole company, their operating income increased by 27%. So a really solid year. The company's stock portfolio gained a lot of value. That's not included in those numbers. That's included in GAAP earnings, but not in operating income. Markel Ventures is the part that owns stakes in businesses. That is performing very, very well. So really solid fourth quarter all around. But the biggest news by far is that management said that they are going to conduct a thorough review of their business. Essentially, they're going to take a step back and see what they can be doing better to make not necessarily make the stock go up, to make the market kind of appreciate the value of this company. So the goals are to optimize the insurance business, optimize capital allocation, and to simplify the structure of the business. A lot of times, if businesses have a complicated structure, the market just doesn't know how to value them. So management, this comes straight from their earnings report. The first bullet point's a fact. Over the past 5 years, Markel's stock price has grown at a 9%. It's a compound annual growth rate, so a 9% annualized rate. And just based on their sum of the parts valuation, which they break down in their earnings report, and it seems completely real, it's true. Over the past 5 years, Markel's intrinsic value has grown at an 18% annualized rate. So, in other words, intrinsic value of the business is growing twice as fast as the market is recognizing in the stock price. So this implies, just extrapolating those two growth rates out, this implies that over the past 5 years, the stock is up about 54%, which it is, but the intrinsic value of the business is up by 129%. So, in other words, the business is worth a lot more than the market seems to be giving it credit for. Management is estimating a intrinsic value of about $2,610 today. That is roughly 38% more than the stock price as I'm recording this. So it's not just that I think that the valuation gap is going to eventually close. I do think it will, start to close a little bit. Stocks don't trade for massive discounts to a clear intrinsic value for too long before you have an arbitrage opportunity somewhere. So I do think that the gap will eventually close, but there's a few things that I think could kind of accelerate this path to $5,000 a share. And that's a pretty ambitious target by 2030. And that's my target, by the way. That's not Markel's. I think it's entirely possible. I think that the stock could more than double in 5 years if things go well. One, in addition to announcing the strategic review, Markel also announced aggressive buybacks. They announced a $2 billion buyback plan that represents roughly 8% of the outstanding shares at the current valuation. Buybacks are also part of the strategy, or they've always been part of the strategy. But I mean, Markel's share count's gone down by about 10% over the past 5 years. So this would be an aggressive buyback plan. The insurance business, the investment portfolio generated by the insurance business is doing fine, but the business itself, the combined ratio is too high. If you're not familiar with how the insurance business works, basically a combined ratio above 100% means that you are not profitable on underwriting. It means you're paying out, the money you're paying out for claims combined with the costs of running the business are more than you're bringing in customer premiums. Markel's is just over 100%. You want it to be substantially lower than 100%. Something in the low to mid 90s would be, what I would look for as an investor. So underwriting is not profitable right now, and it's not totally Markel's fault. Another thing to know about the insurance business is that premium increases generally have to be approved by regulators. You can't just slap a premium increase on people. A lot of times it's kind of a reactive increase. So when I say cost inflation has outpaced premium growth in insurance, that means, let's say they're insuring somebody's house and unfortunately the house catches on fire and needs to be replaced. The cost of rebuilding a house has gone up significantly over the past few years, and insurance premiums have not quite caught up with that. So if I think the combined ratio is going to normalize over the next few years, of course, there's a lot of insurance stuff you can't predict, but I do think it's going to normalize a little bit. Their investment returns have been very strong over the past 5 years. The stock portfolio has gained over 14% a year on average. So I think that's going to be a nice little catalyst going forward. But all in all, I do think there's a lot that is going to work in Markel's favor over the next few years. I mentioned the buyback already, $2 billion stock buyback. And it makes a whole lot of sense. If they estimate their intrinsic value to be about $2,600 a share, and they could buy back shares for $1,900 to $2,000, why wouldn't you do that as often as possible? That would be like buying $100 bills for $80. So presumably this is to take advantage of the valuation gap so they can create a lot of shareholder value that way. All in all, I think Markel is going to have a very, very strong performance over the next few years. And I'm actually considering adding to my position. I haven't bought any more Markel for probably about 5 years now. But I'm considering finally adding to the position. I'd love to know what you think. Do you think Markel is going to outperform the market? Do you think it's kind of just going to market perform? Or do you not like the business at all? Leave me any comments you might have. I'll do my best to answer any questions you have individually. And please click subscribe to my channel if you don't already. And thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.